So we've got ourselves backed into a corner, and bad news is good news for asset holders in this environment because it means that the easy money will keep flowing.
This week's specials with Miles Franklin Precious Metal Investments. 1,000-ounce silver bars for only $169 over spot per ounce, with 90-day free storage. And 2021 Silver Britannias for only $3.95 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty in Finance. And back with us today, our good friend Jerry Robinson from followthemoney.com. Jerry, thank you so much for joining us today.
It's great to be here. Thanks, Elijah.
What I really wanted to touch on today is the gold market. We've talked about this in the past, but recently we've been seeing a pullback and now a little bounce in both gold and silver. Your perspective, where we are today?
Well, we like gold. I mean, gold is the place to be for long-term protection from the currency debasement. So it's a long-term story. We've been long gold for a long time. I personally, allocate about 15% of my total investable assets to the precious metals complex. I like gold. I like silver. I like platinum as well. But kind of zooming in on what's been happening recently, gold and silver are popping as we speak, as we do this interview, silver off of some lows, but gold is perking up. It's been hanging out right around the 200-day moving average, and the U.S. dollar has been pulling back. Now, this is all, as we record this is in the wake of the FOMC meeting, and Jerome Powell made it pretty clear on that latest policy announcement that there's no immediate plans to rate hike or to raise interest rates anytime in the near future. And so we have that, which is bullish for gold. I think most gold investors were, and commodity investors in general, were looking for anything that came out of the Fed suggesting tapering, the big T word they've been watching for. And we didn't hear too much. I mean, the Fed certainly could have been more aggressive in saying that they were, they had a timetable and a plan. They did suggest they would start tapering later this year. But that's, again, totally flexible. They could change their minds at any time. So nothing set in stone. So I think gold is rallying on that. You also have the World Gold Council that just released a report showing that gold demand globally has been surging. Central banks, of course, continuing to buy gold. But we've seen some strong gold demand from the World Gold Council. And we also supporting gold, I think, here is this morning we got a bad Q2 GDP number. It was much lower than analysts had expected. And I think the fear here is that we certainly have peaked on the economic growth. We had this wild, crazy economic situation in 2020 where we had devastating GDP report for the beginning of the year, and then a robust rally, of course, that you would expect when you're starting from zero. You would go back up, and now it's starting to peter back out. And now it seems like we've peaked as far as total growth. So, I think that's also putting a bid underneath gold here. So you've got gold in an uptrend, technically speaking. In fact, there's actually a potential cup and handle pattern that's playing out on gold right now. If you look at a daily chart, you'll see that there's an interesting cup and handle pattern that's forming, and it'll resolve if we can around the 200-day moving average. So it's kind of interesting. I like when a cup and handle forms right below the 200-day moving average, because the 200-day moving average then breakout carries even more significance. Typically, whenever an asset breaks out above its 200-day moving average line, that's bullish, especially when it's on higher than normal volume. But when that occurs as a pattern, like a cup and handle is also confirming, then it's kind of a double whammy. And so looking for gold to break out around 1833-ish right now, maybe 1835, somewhere in that range, that would signify, more steam ahead for gold. And it's really going to depend upon the dollar. The dollar has been relatively strong in the near term. Of course, it remains mired in a long-term downtrend, but the near-term strength is really what's been putting some downward pressure in the dollar, has been putting downward pressure on gold. So I think the story is clear. Elijah, we're nowhere near the end of money printing by the Fed. Gold is in an uptrend. Rates are going to have to stay, near zero for quite some time, because in order to service the massive debts that the government has, consumers have, businesses have, assets and wages, are going to continue to need to be inflated to keep the economy appearing strong. So we're bullish. I mean, we're bullish on gold and on silver as well. Although silver is more speculative, there's plenty of reasons to be bullish on silver. But we like them both.
Now, with respect to the economic data and what we're seeing in the markets, I mean, GDP rose 6.5% last quarter, so that traditionally would be a good number. But if we're looking for a rebound since COVID, that was disappointing. So, interestingly enough, we saw from the stock market that the stock market still rose. We're about at all-time highs right now. So, why is it reacting positively to this disappointing economic data?
Well, because it continues the narrative. So the stock market is completely addicted to money printing. And so bad news is good news for the stock market, in this case. So, and of course, they're not the same thing. Economy is not the stock market, vice versa. But whenever you have a confirmed data point on the economy that shows that it's weaker than expected, all that investors can infer from that is that the Fed is going to say, I guess we can't raise rates anytime soon, right? Because the economy is still too soft. However, if we had seen a very robust number, a beat on the GDP, that would have actually, ironically, probably put a damper on stocks because perhaps, and even on gold and silver, because it would then lead people to say the Fed may have to raise rates quicker, right? It's all a guessing game at this point with the Fed, but it really boils down to the T word. We know the order of what the Fed is going to do. They've already been very transparent about this. They're going to be, and they've really tried to explain that they're going to be transparent. And it's kind of ironic to say that the Fed is transparent, which it's not. But with their policy actions, at least, they have stated that they're not going to try to surprise the markets. They know they've learned from the past, they claim, and they're going to be tapering, cutting back on that $120 billion monthly bond buying program that they are currently doing. Their claim is that they're going to begin tapering that, meaning they're going to start cutting that down, maybe cutting it down to 100 billion 1 month, and then maybe a few months later cutting it down to 80 billion. And then finally, when they get that down to zero, then or near zero, then they will also start, then the next policy measure will begin to raise interest rates. Well, all of this assumes that the economy can handle that. And this is what we've been saying from the beginning is that, with the amount of debt that's in the system, it's almost absurd to think that the Fed can raise interest rates to even to a natural level. I mean, I think a natural level, and I've said this before in your show, but if interest rates were raised back to the 30-year average, if you look at the 30-year average on interest rates, it's somewhere around 5.67%, okay, here in the United States. Right now, they're near zero. But if we saw interest rates at 5.67%, which is the level they've been at for the last, average level for the last 30 years, I mean, the economy would crash. People couldn't service their debts. Businesses wouldn't be able to service their debt payments would be outrageous. The government would be in trouble because much of their budget would be consumed with interest payments on their debt. So we've got ourselves backed into a corner, and the bad news is good news for asset holders in this environment because it means that the easy money will keep flowing. The worst news that could happen, I think, for the stock market and for commodity investors is that the economy, and this is so ironic, but that the economy would then start to show the actual nominal GDP would actually start showing growth because this would change the narrative. We don't expect that to happen. In fact, we think that we've already seen the peak in GDP growth. When you look at the analysts, Elijah, and look at their estimates, I mean, we're going back to 2% growth again. So we've had this weird, crazy, blip in GDP. Historically, it'll be seen as a major event, but it's still kind of a blip on the screen when you look at it macro level. And we're going right back to 2% growth, maybe sub 2% growth per year. we're in a bad spot. And, this is why people have got to be diversified. They must not put all their eggs in one basket. They must not have all their money in paper assets. They must have real assets. We like real estate in this environment, although it's crazy prices in some areas. There's some crazy prices going on. Not every area is a great place to invest, but if you're in an area where real estate is not crazy, which there are several places still, it's a great investment. Gold and silver, they're relatively finite. I mean, they certainly are finite in supply. And there's other areas as well. But yes, we are in a pickle here. And the Fed is just simply out of options. They have to keep pumping money in. And bad news is good news for investors at this point.
It's such an interesting environment. The bad news is good news. And it seems like if the Fed is going to just continue with the easy money policy, and we're going to see really a slowing economy, that seems like stagflation, which seems to be the best possible situation for gold. Yeah,
I would say. I mean, the Fed does have it's faced with a two-pronged problem here. It has, this slowing economy, and then it has rising inflation, right? That's kind of what you're talking about there. So, yeah, they're faced with a big problem. And the problem is that they can't really raise interest rates, as I've stated, to deal with the inflation. So it's like they're handcuffed, which, again, builds the case for precious metals.
Now, one of the things that has been a case for precious metals is the Basel III, the new regulations coming out. It essentially has been a month since some of these regulations have been implemented. Did you want to share with the viewers kind of your understanding of Basel III and why it should be bullish for gold? Some people have said the effect will be delayed. And really, what is your perspective on what effect it has or will have on the gold market?
Well, it's good news for gold investors overall, net. These Basel III rules were put into place back in the wake of the 2008 economic crisis, trying to make banks trying to bring more regulations to banks, make them more solvent, make them more transparent. And so, precious metals investors have long been looking forward to the Basel III rules actually being implemented. And basically, just to boil it down for the viewer, without getting too geeky on the economics, it's just basically that banks, when they hold paper gold, it's no longer going to be the same thing as physical gold. So physical gold is a tier 1 asset according to the Basel III rules. And what that means is it's as good as cash. So the rules will, the global financial institutions that hold physical gold, it's like holding cash. But if you hold a paper equivalent of gold, then it's not treated like that tier 1 asset. That's the big distinction. And so what's the benefit? Why would that be bullish for gold? Well, because it disincentivizes banks to hold gold in a paper form. It incentivizes them to hold it in a physical form. And if you understand economics, supply demand, if the banks then have to go liquidate those paper positions to get into physical, well, there's only so much physical. And so it builds the case that gold prices could go up. But there's a catch, as usual with these things. And the UK banks are already starting to slither out of this. The LBMA and other institutions are balking at these rules. As you can imagine, banks don't like this idea, and they're fighting this idea. And they're already carving out in the UK exceptions to these rules. So I'm a little mixed on how I feel about the Basel III. In theory, it's a wonderful idea that banks shouldn't be able to take on these very speculative types of assets and consider them to be gold, holding paper gold. But at the same time, these banks rule the world, and they have a lot of political power, not just economic power. And so they're already starting to wiggle with the rules and change the rules to their benefit. So we'll see. We'll just see how much power these rules will ultimately have. It may take, from the contrarian viewpoint here, it may take another major economic crisis to be able to enforce these rules. So this may not be the silver bullet that many people were hoping for, because the banks are, as I stated, the regulators are already carving out exceptions. So we'll see. We'll just have to kind of watch it and see. But certainly after the next economic crash, it will probably be very difficult for banks to get around these rules.
Can you kind of help our viewers understand then, because what is the difference in your mind between holding physical gold and having some sort of paper equivalent? It seems like the regulators at least do see a difference between those. So in your mind, what really is the difference between those two options?
Well, in one case, you don't actually hold the metal. You're holding a forward contract. You're holding some piece of paper that it's a paper claim to gold in some way. Or it's not even a claim. It's just simply a contract of some kind that in essence doesn't mean that you actually own the physical gold. And this is why the rules are being imposed, is because it brings a tremendous amount of uncertainty to the banking system whenever it's entirely built upon paper. I think it's a great idea that banks should hold gold. I mean, quite frankly, Elijah, the banking system in the United States is a total fraud. I mean, I hate to be so forward about this, but I mean, it really is. I mean, it's an absolute fraud. And if people understood it, there would be people panicking in the streets. I mean, if they really understood the fraudulent nature of the banking system, it would be crazy. I mean, it doesn't matter what bank you go to here in the United States. If every customer went down to the local bank and requested their money back, they would find out that the bank doesn't have it. The reserve ratio requirements for these banks is extremely low, and they're constantly meddled with by the regulators. And that means that the banks get to play lots of funny games. They get to play all kinds of games with the fractional reserve banking, reserve ratios. And so the banking system is not nearly as solvent as we all want to believe that it is. And so for this reason, imposing rules like Basel III and saying, look, banks, you have to hold gold, real physical gold on your books if you're going to claim to be owning gold, if you want it to be treated like a tier 1 asset. And I think it boils down to the viewer who's watching this. What does it mean for him? Well, it means that it's better than holding a gold ETF. It's much better to hold physical gold than to hold a gold ETF. I mean, if you don't hold the metal, how many times do we have to say this, Elijah? If you don't hold the metal, you don't own it. You just simply don't own it. And this is why owning physical gold and having possession of that physical gold is one of the most important things that you can do for your financial plan. Gold is not really an investment. It's really kind of like what Basel III rules say. It's cash. I mean, it's literally cash. It's money. And so in that case, having physical gold in your portfolio is in some ways whatever cash is to you, that's really what gold is. And in some ways, it's insurance against economic calamity, which we certainly are dealing with, even though we've tried to paper over the problems and suspend economic reality. We can't fight it forever. And, it's going to come home to roost. So preparing now is the best thing you can do.
In your perspective, because you mentioned how there is the fractional reserve banking, right? And if you really look into it, it's explicit. If you hold money in the bank doesn't really keep it there. They lend it out, right? So there's a reserve requirement. It's very open, I guess, what the banks are actually doing with your money there. It's not all there in a sense. Now, with respect to the paper forms of gold and silver, when it comes to ETFs and stuff like that, there is speculation that, maybe not all the silver or gold is there, but is there any explicit or outright statements and stuff like that by the institutions themselves that say, actually, this is not equivalent to just owning the physical metal?
Well, I think there are some, ETFs that try to do that. The Sprott Group, for example, has some ETFs that are supposedly physically backed. And I say supposedly because I haven't delved that deeply into their documents. But from what I understand, they're physically backed. You can redeem that share of an ETF for physical gold. And that's what I've heard. I've never done it, but that's what I've heard people can do. Other ETFs are pretty explicit that, this is really just a tracking device to allow you to track the price of gold, but you can't redeem it for gold. So again, what I teach our own students here at followthemoney.com, we have many students around the world, investing students, trading students, and what I teach them is that, have a core position in physical metal and don't rely upon ETFs. Even those that are claimed to be backed up, I know it's great. I know that sounds good, and I'm not saying that they're not good or they're not legit. But I think it's just a better mentality, a better psychology to have physical gold in your portfolio. So, yeah, I mean, some ETFs claim to be backed by gold, and I don't dispute those claims, but I prefer to have physical. That's what I invest in.
I think one of the key elements is that when you're investing in precious metals, it's the biggest reason to do that is for insurance, right? And the less counterparty risk you can have, the better. Absolutely.
That's the whole point. When you have the physical bar of gold in your hand, there is no counterparty risk. That's really the major risk you're dealing with in the gold markets, because there's a lack of transparency in this situation. Same thing with the silver markets. You really got to hold it in your hand. It's the same thing with cryptocurrencies. If you don't have the cryptocurrency in your own wallet, if you don't hold the private keys, you just don't own the crypto. So anybody in your audience who also invests in cryptocurrencies, the same principle applies. When we buy Bitcoin, we keep it in cold storage, right? So we don't keep it on exchanges. If you keep your Bitcoin on an exchange, you don't own it. I mean, you don't have the private keys, the exchange does. So it's the same kind of principle. When you buy the Bitcoin, you bring it, you put it in cold storage, you put it on your hardware wallet, and then you own it, right? Then the private keys are in your hands. The same thing with gold and silver. You hold that physical in your hand. That's the principle.
Before we let you go, also, did you want to share with the viewers where they can find you online and sign up for your program, really? Because if our viewers are interested in supporting our channel and also signing up at followthemoney.com, they can use the discount code LIBERTY to get 10% off.
Yeah, that's right. Yeah, we have a coupon code for all of your listeners, Liberty. Whenever you check out at Follow the Money, just type in the coupon code Liberty. You get 10% off of your plan for life. And on top of that, you support Liberty and Finance channel. They can go to followthemoney.com. Maybe the best way to get started is just to sign up for our email newsletter. You go to followthemoney.com, right there on the front spot. You can find the email newsletter right there. We send out a few emails per week with some information. You also get access to our podcast. That way, it's sent right to your inbox. We also send out several free reports that you'll get whenever you sign up for our email newsletter. But we have so many free resources too. Elijah, we have a number of podcasts. We have a precious metals podcast. We have a stock trading podcast. We have a Follow the Money podcast, which talks about economics and entrepreneurship and things like that. So followthemoney.com, great place to go to learn. But then we do have those premium plans. So if you go to Follow the Money and click on plans and pricing, you'll see a silver, gold, and platinum plan, which is kind of fitting. And all of those plans depends upon how much coaching you want, how much information you want, how much access you want. So if you want to know exactly what I'm trading, what I'm buying, when I'm buying it, that will be the platinum membership. If you want to know, if you want to get great education, you want ongoing coaching, you want access to all of our services, for the most part, that would be the gold membership. And if you're just kind of kicking the tires and just kind of learning about us and you just want a daily trading idea or something along those lines to get some basic education, that's our silver plan. So, but either way, if you sign up for any of our plans, be sure to enter Liberty for your coupon code to get 10% off for life, and it'll support your work, your good work, I should say, at your channel, Elijah.
All right. Well, before I let you go, any last thoughts you'd like to add, Jerry?
I would just tell people to be diversified, as I've been saying for many, many years. Just in this environment, it's wild, it's crazy. It may feel fine for some people, especially if you've been invested in the stock market or you've been invested in certain areas. It may seem like everything seems okay, or if you've been investing in real estate, everything's going up. It seems like it's great. I would say that this is a very, very dangerous illusion that we're in, that this is an experiment that is not going to end well. The best way to protect yourself is to diversify. Don't put all your money into any one thing, no matter what it is. Don't put all your money into any one thing, because the rules of the game can change, and the government makes the rules. So you got to be nimble, stay diversified, and that's the only way you can protect yourself as we go forward in a very uncertain economy.
Fantastic. Jerry Robinson from followthemoney.com. Thank you once again for joining us, and God bless.
My pleasure, Elijah. Thank you.
This week's specials with Miles Franklin Precious Metal Investments. 1,000-ounce silver bars for only $169 over spot per ounce, with 90-day free storage. And 2021 Silver Britannias for only $3.95 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237.